business organizations. Some of you guys maybe have started businesses already. Maybe you will one day. All right, maybe you work for somebody else's business and you have some questions about how things are set up or how they're run. All right, so I wrote the book on business entities. Actually, it's not quite as impressive as it sounds. I did a continuing legal ed for lawyers, and turns out the law library bought a copy of the manual and bound it and put my name on it, which I thought was really cool. So, I don't know, I sent that picture to my mom and my grandma. They were impressed. Maybe you guys will be. I think it sold like all of 2 copies. So, but I can actually say there's a book in the law library with my name on it there. In addition to your textbook, which is also pretty awesome. So how did corporations and companies and LLCs and all these different terms that you hear, like what's the root of these things? All right, well, I wrote the chapter in your book on business organizations, and I had a little fun kind of digging back into the history of these things. You know, I knew that our corporate law comes from the English system, like so much of our law does, but I was kind of curious, like what was the first corporation, you know, or what was the first partnership or things like that, all right? And so I dug way back in there, and there's kind of 2 big historical sources. One area of research that I looked into kind of looked at churches and how churches owned property and land and buildings and things. And so some people think that was kind of the first company, and we still have some roots of that today in like nonprofit corporations, which churches often are, okay? On the more for-profit side, you had exploration and adventure, okay? Things like the East India Company. I didn't expect my research to take such an exciting and adventurous turn, but the East India Company was one of the first, what we would consider a modern corporation. All right, so you had folks in Europe and what we now would call the Old World, and they were interested in exploring the New World. All right, and back then, if you were going to make an exploration to the wild lands that we now find ourselves in, you needed a lot of people. You needed ships, you needed weapons, maybe horses, food, all kinds of stuff. And to get all of that stuff and to pay those people, you had to have money, okay? So who has enough money to outfit an entire expedition? Well, royal families did, and many explorations were funded by royal families, but then people had the idea, well, what if we got together and made kind of like a private company that could go do these explorations, and people could put money in, invest money in, and then if we find gold or, you know, exciting things, then they can get a return on their investment. And so things like the East India Company then were kind of the first startup business in the form of a modern corporation as we know them. People put money in, they own shares, the exploration went, hopefully it went as planned. People, you know, either got some return on their investment or probably in many cases lost their investment. Okay, but they were able to sit safely over in Europe, and just their money was doing the traveling. All right, and that kind of describes how most people would do their investment today. All right, if you have some extra money, you might look into mutual funds or stocks or something like that. It's unlikely that your first thought is going to be, I'm going to run out and buy part of a company and work there, right? It's not usually what you're thinking. You're buying some shares and you're hoping you get dividends or that your investment goes up. So that kind of underlies our modern ideas about this, okay? So we're going to talk about all these different modern types of entities, but I'm here to tell you they haven't necessarily changed a whole lot since the East India Company. Now we have more kinds of entities. Some of these have kind of evolved, but really a lot of this is we're going to see the basic building blocks. So we're going to talk about sole proprietorships, We're going to talk about partnerships. We're going to talk about some of these different kinds of corporations. We're going to talk about LLCs. We'll give a little bit of time to nonprofits and unincorporated associations, and then we'll talk about the franchise form of business as well, which is not an entity like these, but it's a very familiar way of doing business in the U.S. All right. So as a business lawyer, when people come to me and they're starting a business and they think, okay, yeah, we need some kind of legal entity, they are not necessarily coming to me with an idea that, yeah, I need an LLC that's going to make a subchapter S election, and we need, an employee stock ownership plan, da-da-da-da-da. All right, if they're very sophisticated clients and they've done that before, maybe they have that idea. But the laws change around these things a lot, and the tax laws change a lot, okay? So what they usually come with is kind of a list of, here's what we want this to do, here's what we want this to look like. What's going to be the best entity choice for us? So they're looking at how easy is something to start, what kind of protection for their own personal assets are they going to get, what are the tax considerations. They're going to have some ideas about the funding structure, the management structure, the flexibility of it, and they're often concerned about the ongoing requirements. Are there a lot of things I'm going to need to do to keep this going? Okay? So we talked to them about the different forms of business that they might want to look at. Okay? Now, the oldest form of business is the sole proprietorship. And to even call it a form of business is really overstating things a little bit, because anybody who just goes out and does business has created a sole proprietorship, okay? So if you sell lemonade in your front lawn when you're a kid, you were a sole proprietorship, okay? The small business development authorities believe that this is the most common form of business organization in the U.S. They estimate about 2/3 of American businesses do business as a sole proprietorship. I'm saying estimate because we don't have a good way to track these, because there's no registration for them, okay? So if you just go out and start doing business, then you've got this. You're not necessarily going to, be registering with any state or county or city authorities, okay? In a sole proprietorship, you're responsible for the control and the management of the business, okay? You're the owner-operator. That has some good things, like the simplicity of that, but there's a downside too, okay? The major downside to working as a sole proprietor is you are the business and the business is you from a financial standpoint. So if you have personal resources, you are risking those in terms of the business that you're in, okay? So in other words, if you're a sole proprietor and you get sued, it's not just the assets of the business that can be attached for a garnishment or a judgment. It's your own assets as well. Your own bank account, your personal property. Normally your house is not subject to garnishment, but in some states, if you have a really expensive house, you might not qualify. All right. So individual and unlimited liability. I had a professor who said this was the kind of turn them upside down and shake their pockets out kind of liability. All right. The other thing is you can't issue any shares of stock or securities out of a sole proprietorship, not legally anyways, because you are the business and the business is you. You can't sell shares of you. All right. So any capital that you're going to put in has to be yours. Maybe you're borrowing it on your own personal guarantee, or maybe it's your own money. But you can't bring in investors, technically, into a sole proprietorship. On the good side, the tax part is pretty easy. Okay, you don't have to file a separate tax return. You just have an extra schedule on your income tax. All right, and I doubt you made enough on the lemonade stand to qualify for the sort of the minimum taxation. But older folks, if they're making a certain amount of money, well, it just goes right on their personal tax. It's easy to set up because there's literally nothing you need to do other than go into business. But there's a lack of continuity. If you're a sole proprietor, you could have employees, all right? Many sole proprietors do. Think about like restaurants. I've seen construction companies, fairly large ones, run as sole proprietorships. Maybe you've got employees, you've got equipment, you've got bank accounts, things like that. And then what if the owner dies? Well, all that stuff is going to go to their heirs, and the business essentially would close. Okay? So there's a lack of continuity. So would this be a good form of business if you were going to sell food? What do you think? Thoughts? See some people shaking their heads. Probably not, all right? Probably not a good form of business really for anybody. I can't think of a situation where I'm going to recommend this form of doing business except literally for the kid who's selling lemonade. Because what if somebody gets sick from your sandwich? Or what if they trip and fall and hit your food cart and hit their head? Okay? Well, it comes back on you. So the really big bummer of this is that individual unlimited liability. Okay? You don't want that. Part of the reason that you set up a business is to put the assets legally separate from your own. Okay? So that if your business fails, you could lose the business, but you don't lose all of your own money. So this is probably not a great choice of entity, really, for anybody. And like I said, I've seen major construction companies operate this way, and I can tell you we got a $2.6 million personal judgment against a guy because he committed fraud through his sole proprietorship. Okay? He was not real happy about that. With a little bit of money on the front end to a lawyer, he probably could have sectioned off some of that liability. So the second oldest form of business is a partnership, okay? And once again, you don't have to file or really affirmatively do anything to be in a partnership except to do business with somebody else, okay? So you team up to do business for profit with someone else, and you've created a common law partnership, okay? I think historically, when I started to look into the roots of these, there's very simple examples of like people going in to, make a retail store together, like a general store, different kind of stores they would have in the old times. And then they also had guilds, which, were groups of craftspeople who had a skill, and they kind of banded together to produce things. And if you're doing business with somebody for profit and you're sharing the profits, that's a partnership. Over time, we began to create some laws about partnerships, both setting up different kinds of them and kind of clarifying some of the rights and responsibilities of the partners. And the courts interpreted different cases. And here's where we first kind of had this idea of corporate governance, and that comes out of the idea of the duties that you owe your partner when you're in business with them, and the idea that it's not just every person for themselves, but when you partner with somebody, you have some duties and some rights in coordination with them. One of the things you've probably heard of if you've had, any kind of accounting classes or finance, or if you're just sort of interested in these things, is the term pass-through taxation. All right? A partnership does not create a separate legal entity in and of itself. We call it an entity. It's really not. It's an association is what it is. Okay? It's people who have banded together, but it doesn't create a separate entity that pays tax in and of itself. So if you're in a partnership and you make some amount of money, you're going to get some tax information, but essentially you're going to pay on your own income tax form, whatever, you're going to pay tax on whatever it is you made from that partnership. So it's not taxed at an entity level, okay? Partnerships were very popular for many years until we started to get laws about LLCs. I think that sort of turned the tide away from partnerships in a lot of settings. Corporations replaced them in some settings as companies got larger. So you don't see a lot of these today. Sometimes state laws have some advantages. Like in Iowa, there are some advantages for farmers who have a group of family members. So you may have heard of family limited partnerships for farms, okay? But we don't do a whole lot with them. Historically, lawyers, folks like these guys, accountants, doctors, a lot of these kind of folks would practice in a partnership form. And many of them still do, and we'll talk about the reason for that as well. So a general partnership is just the really basic kind, okay? This is kind of the default case, if you will. Two people make some kind of agreement to carry on as co-owners a business for profit. Doesn't always have to be a written agreement, although some people will make an agreement in writing. Could be an oral agreement in some cases. And it can also arise just out of conduct, if you're just carrying on a business for profit with somebody else. And each co-owner is called a general partner, all right? And they can form an agreement as to how the partnership is going to be run. Or there can be certain default rules in the state law. When everyone is a general partner, everyone is liable for everyone else and what they do. Okay? So it's kind of the problem you have as a sole proprietor, but made worse, because if you've got 3 other partners, you're not only personally liable for what you might do, but you're liable for what they might do. So suppose you're a doctor, all right? Doctors get sued all the time when things go wrong, okay? Would you really want to be liable for something that your partner did when you weren't even on that particular case? Okay? It's not a great situation, all right? So we call that joint and several liability. So joint and several liability means a plaintiff can sue and collect a judgment from one or more of the partners separately, severally, or individually, or all of the partners together, even if the partners did not participate in, ratify, or know about whatever it was that gave rise to the cause of action. If you signed a lease and you have roommates, you most likely agreed to joint and several liability for your roommates. So say you are gone for the weekend and your roommate goes on a bender and punches a bunch of holes in the wall. I speak from experience. I used to live with 6 other guys when I was in college, okay? Or suppose somebody decides to, I don't know, rent a motorhome and park it on the front lawn and tear up the grass. Been there. You say, I wasn't even there that weekend. And the landlord says, yeah, you know what, though? You're the only one with a job. I'm coming after you for the damages. That's joint and several liability. You put yourself on the hook. Could you go sue your roommate then? Yeah, I guess you could. Good luck, right? So in a general partnership, you got this joint and several liability. Unless it's otherwise agreed, partners are going to share the profits and losses equally or by the percentage of their buy-in, and they're also going to share the right to manage the business. So the kind of default arrangement is, you have ownership and management rights according to the percent capital that you put in. And you can vary that in the agreement. You can change that. Partners are liable for gross negligence or intentional misconduct. Okay? You're always going to be liable for your own torts. That's one thing that I guess people don't always realize. So no matter what form of entity you're in, whether you're an owner or whether you work there, the corporation is never going to shield you personally. But typically that's not going to matter a whole lot unless you're very, very wealthy, okay? Because if you do something on the job and you damage someone or hurt them, they're going to be looking not so much at, can I sue you? The answer will be yes if you did it. But can I get to the corporation with their big bank accounts and their insurance? Okay, so we usually talk about vicarious liability going upwards, but you're always liable for your own torts. Where does that matter? Well, like the example of the doctor, okay? So you got 4 doctors in a general partnership. One of them commits malpractice. Are you interested in getting at the assets of all of them in the partnership? Yes, but the individual might be very wealthy too. Okay, so sometimes people think this shields them from their own actions, and it doesn't. You're really thinking about shielding your assets from the torts of your employees or your partners. Okay? Partners have a fiduciary duty toward each other, and we're going to break this idea down when we get into the second half of this and we start talking about corporate governance a little bit more. But essentially it means a trust relationship. When you have a fiduciary duty with somebody, you're in a trust relationship with them, and you've got a duty to act in their best interests, even over your own. So if you're an attorney, you're in a fiduciary relationship with your client, okay? You have a duty to act on their behalf, even if it's against your own interests, okay? Trust officers at banks, some investment advisors, an executor of an estate. All of these folks essentially take an oath that they're going to act in the best interests of the client. All right. So what you don't get to do in a partnership generally is compete against it without the permission of your partners, take business opportunities away from it, again, without the consent of the partners, or help yourself to partnership property for your own private enrichment. Again, without permission of your partners. These things can be varied from time to time. Okay? So we had this form of entity, the general partnership, and it was a way for people to do business together, to share ownership, and to share profits. It had significant drawbacks, as I pointed out to you. And it also didn't allow for passive investment, okay? So if you wanted to be in a partnership, and in other words, if you wanted to put money into it and get something back, you're exposing yourself to personal liability. You have to participate in the business of it, the management, etc. Okay? Now what about, you may have heard the layperson's term, silent partner. Okay? What about a money guy? Okay? Maybe you want to start a construction company and you have an uncle who doesn't know anything about construction, but he's got some startup capital for you. Okay? And he's willing to bankroll you in exchange for some kind of return. The limited partnership was created to facilitate that kind of arrangement, okay? And so in a limited partnership, you would have at least one general partner and at least one limited partner. You can have multiples of either, all right? That limited partner is the passive investor or the silent partner, okay? The general partner is just like the partners in the general partnership that we talked about a second ago. They've got personal liability. They're running the company, managing it. The limited partners don't participate in the running of the company. They don't usually participate in the work. They don't vote on things other than maybe major decisions about changing the structure of the company or something like that. So they're just getting some return on investment. Okay? And we'll talk about this limited liability, limited partnership in a little bit too. But this was kind of a step up so that you could put money in a company and you could only essentially lose your investment. Okay? So your limited partner comes in, they put in $1 million, the business tanks, or something horrible happens, you damage a bunch of people, or pollute a waterway and there's $3 million worth of fines. Okay, the limited partner can only lose what they put in. So that's kind of the idea we're having here going forward, is limiting your downside risk with some of these entities. So a sole proprietorship or a general partnership, there's unlimited downside risk. You can lose everything you own because they can go right through to your personal stuff. Okay? Limited partnership is the first time where we say you can only lose your investment. That's a good thing, right? People would like to put money in and not expose themselves to unlimited liability. Now, take that one step further, and we've got limited liability partnerships. So these came out of a situation in the 1980s where you had these savings and loan companies, and they were kind of like banks, kind of like credit unions, banks, financial companies, okay? They weren't regulated quite the same way as a bank, but they were basically banks. And the state of Texas had a number of these. And turns out some of the people running them were pretty crooked. And it turns out some of the lawyers and accountants they had helping them were also kind of crooked, okay? And these weren't just local lawyers and accountants. These were folks who worked for big firms that had offices all over the country and sometimes all over the world. And they had thousands of lawyers or thousands of accountants, okay? When the savings and loans collapsed, a lot of people lost their money that they had stored there or invested there, okay? What do rich people do when they lose their money and they get pissed off? They sue people, right? So they go and they try to sue the savings and loans. Well, there's nothing to get. They've collapsed. So they come up with a relatively novel idea. Let's sue the lawyers and let's sue the accountants who advise these savings and loans. Okay, well, that's a handful of people. Well, no, they practice in partnerships. So we can sue the whole partnership. So all of a sudden, you've got accountants sitting in New York who've never even been to Texas, and they're getting sued for something their partners did down here. All right? If you want to see laws change in a hurry, piss off other rich people, like lawyers and accountants. Okay? So they said, whoa, this is terrible. We can't do this. We either have to break up our national firms to segment off the liability, or we have to get some new kind of entity where this can't happen to us again, because it's not fair that we get sued for something our partner did when we've never met that person, we haven't worked on that account. That's crazy, right? So these limited liability partnerships came about, and these were created through state law. Texas, of course, had kind of the first ones, and then I believe every state has some form of this now. And it's essentially a partnership, but the individual partners are not liable for the actions of their other partners, okay? The individual partner who commits the wrongful act is going to be liable. So if you fake an audit and you work for say you work for Deloitte and you fake an audit and it costs people money, you can be personally sued for that. and maybe the partners who supervised you can be sued for that, but they don't get to go through and sue all the partners of Deloitte all over the world. Okay? Aside from that, it looks pretty much like any other partnership. Taxation is the same. You file something with the state that you do business in to say that we're in this form of entity. All right? So most of the really big accounting firms are LLPs. Most of the really big law firms are in this form. For reasons we'll talk about in a little bit, they're not allowed to be corporations. All right, so most of your big professional services firms are in this form of entity. Corporations have a sort of a different aspect to them than everything we've talked to thus far, because when you create a corporation, it's like creating a new person, okay? And essentially, you have created something separate from yourself or from the other people who set up the corporation, and it's independent from you. It can outlive you. It can be convicted of crimes. It has to pay taxes, just like every other person in the U.S. It has a lot of the rights and responsibilities that a person does. All right, we know from our con law chapters that it can have a religion, can have religious beliefs. It's got free speech rights, okay? But it's the first form of business we're talking about here that's legally separate from the people who started it, okay? The owners of a corporation are called shareholders. I'm sure you're very familiar with that word. And a corporation can be owned and run by one person, or it can be owned and run by many, many people. There's no limit on the amount of people who can own shares other than practical limits of your imagination, right? Board of directors is kind of the highest level management, although they're elected by the shareholders. And the board of directors hires professional managers to do the day-to-day work. And we'll get into that structure in some detail, of course, but that's kind of the high level. I love these clip arts of the person, the corporation. Somebody said, I'll believe a corporation is a person when Texas executes one, right? Grim humor. But a corporation can be owned by a single person, unlike a partnership. There is some upsides. There are some upsides and some downsides to doing business in corporate form. Among the upsides are some very strong liability protections, okay, which we will get into in a minute. Generally, the downside is the tax thing, okay? And this has changed since I wrote these slides because we have a new tax code. But a corporation has to pay taxes on its profits just like we would for any job we have, okay? And then if the money leaves the corporation in the form of dividends to shareholders, you got to pay taxes on that again. So it's what's called the double taxation problem. And this is kind of changing in some ways, but it's still present. So different types of corporations you can have. You might, I'm sure you're familiar with the term a publicly held corporation. Essentially, this is just a corporation where the shares of it trade on some kind of stock exchange. It's likely to have many shareholders. So if a corporation goes public, initial public offering, publicly traded, all of those different things tell you that you could most likely go to a broker or go online and buy some shares of that company. Okay? Contrast that with a privately held or a closely held corporation. Okay? Same legal entity, just not publicly available. All right? So think about, I would guess many of the bars downtown are in a corporation form, and they're privately held. So say you really like Bo James, and you go down there and say, I want to buy 10 shares of stock. You probably ask somebody laughs, why would you buy that? I'm with you. Um, but you can't, right? It's not for sale. You know, a lot of those are owned in, you know, in a family or a group of friends or a group of investors. It's not publicly traded. And there's no legal difference in the entity of these two things. If you are publicly traded, you have some more legal responsibilities, though, like Sarbanes-Oxley compliance and some of these other things, all right? We'll talk a little bit about S-corps, which is just a way to change the taxation of a corporation, and then we'll talk a little bit about professional corporations, which is a weakened form of corporation that licensed professionals can use. So the mechanics of incorporating or creating a corporation are pretty simple, all right? You have about a 1 or 2 page document called the Articles of Incorporation. And if you remember from serial number 2, that was one of the clues or exhibits in that assignment. You got to look at the Articles of Incorporation of Serial Inc., all right? And those were legit. That's what it looks like, okay? Essentially, you're going to state the name of the corporation, an address, a person who's a registered agent, which means they're the legal representative that gets mail from the government and who gets service of process. In other words, if you're going to sue the company, they're the person you have to serve. And there are some optional statements like how many shares of stock are authorized, or the purpose of the corporation, or the duration of the corporation. But for the most part, it's really simple. You can probably do it in about half an hour. That gets filed with the state, and anybody can look that up. If you go to the Iowa Secretary of State website, type in a business's name, you can go on there and look at the filings, and if it was filed within the last probably 10 or 15 years, there should be a digital copy of that on there. Then you got bylaws. The bylaws are just the rules. How does the company govern itself? How many directors can there be? How do you do the voting? Is it majority, supermajority? You know, how many officers are you going to have? Those things don't get filed with the state. That's usually just held in the company's offices. So you may have heard the term C corporation or a C corp. It kind of an obscure reference to the part of the tax code that governs this. It's just your basic run-of-the-mill corporation. If you don't do anything else when you create a corporation, it's going to be this, okay? Some of the advantages about having a regular old run-of-the-mill corporation, well, we've got a couple hundred years of cases interpreting the rights and responsibilities of directors and shareholders and lien holders and judgment holders and everything else, okay? If there is a question about corporate law, you can find a case somewhere, okay? So we have a really good body of law. This is not a new form of entity by any means, so it's very predictable. They're easy to set up and maintain. If you're out and about and you see a business that has the letters Inc. or Ltd, CO, Corp in its name, then you know you're dealing with a corporation, okay? The downside, like I said, is the tax thing. Corporations are independent of their people, so they can have their own debt, they can be convicted of crimes, but remember that it's not usually going to flow back through to the shareholders. If you buy $100 worth of Facebook stock, and Facebook gets hit with this giant fine by the FCC, right, where they said it could be anywhere from $1 billion to more money than is in the known world right now, okay? So suppose they get hit with a $14 trillion fine or whatever they're possibly contemplating, which is not going to happen, but suppose they do, okay? Is the FCC going to come to your door with their hand out saying, okay, we calculated your share of this, you own 0.001 of Facebook, so that's going to work out to $37,000, right? whoa, now I just wanted to buy $100 worth. I thought it would go up in value. No, can't do that. It doesn't go through that way, right? I'll tell you at the end of this module about some very limited cases where people can be liable, but usually you've got to do something yourself, okay? So that's the benefit. You can put some money in, maybe you earn something on it, maybe you lose it, but all you stand to lose is what you put in. Nobody's going to come knocking on the door. No creditor of the company is going to come knocking on the door looking for you. The S corporation. This is just, you start a corporation and then you send a notice to the IRS saying we want to be taxed differently. Why would they do that for you? Well, because your kind and loving elected representatives have set up this kind of entity change for small businesses, okay? So before we had the change in the tax code, we had this double taxation issue that I told you about, and the implicit tax rate on corporate earnings was about 60%. So it would get taxed once at the corporate level and then once at the individual level. That was suboptimal for a lot of small businesses, okay? So the subchapter S said, okay, we want the liability protections of a corporation, but we'd like to be taxed more like a partnership, a pass-through entity, and it was allowed for smaller businesses. You had to have less than 100 shareholders. Everybody's got to be a citizen or permanent resident of the United States, so no foreign investors. And you got this kind of tax break, okay? These are still available, and there are some additional tax incentives for these now. I thought it was cute. They cut out lawyers from the additional tax exemption and accountants, right? But I don't know the exact numbers now, but this can still be even more advantageous from a tax standpoint than this one, okay? Same liability protection, just an option if you have a small, closely held corporation. And then you've got these special corporations, and these vary a lot from state to state. Most of the ones I've showed you so far are pretty consistent. The partnerships, the C Corp, the S Corp, those look pretty much the same from state to state. Getting good at changing those batteries on the fly. It's a lot of pressure. Okay. So these special corporations vary a lot from state to state. Different states provide different ones for the use of professionals, and they have all different names. So I don't know, I was at the gym today and they had the TV on. I don't really watch a lot of TV, but it's always on at the gym, and most of the commercials seem to be for lawyers. Specifically lawyers from different states that are trying to get people to participate in these class action lawsuits. And you see these law firms, and they have all different letters after their names. Some are like SO or SC or PLC or, you know, all different things, all right? But these are all kinds of special corporations or special limited liability companies, which we're going to get to in a minute. Okay, and so the idea here is that we hold licensed professionals to a higher standard than just ordinary business people. If you're a doctor, a lawyer, an architect, a dentist, you can do a lot of damage in your job, okay? You might have a bridge that falls on somebody. If you're an architect, you don't do your job. You know, you're a doctor, you don't do it right, somebody might die before they were supposed to. And so we don't, as a society, we don't trust professionals with a real strong liability protections that come from the corporation form. Okay? Maybe that says something about us as a society, but that's what the law is. So we do let these folks organize under a similar kind of entity, but it has weakened liability protections. Okay? So They get the benefit of the structure. They can set up voting different ways, different kinds of management, but they don't get some of the other benefits. Like, for instance, you can't have silent partners or passive investors in these kind of firms, okay? In Iowa, and I believe in all states, I'm not 100% sure, but the general rule is that if you want to own part of a law firm, you've got to be licensed as a lawyer and you have to practice in that firm, okay? So you can't go buy shares of stock in one of these firms and share in the profits if they win a bunch of big cases. You're not allowed to, all right? If you're not an accountant, you can't own shares in an accounting firm, all right? It's limited to the people who are licensed. And they don't get the same strong liability protection, but they do and are often required by law to purchase malpractice insurance to protect their clients or patients if they screw up. Okay, so as a lawyer in Iowa, we're required to have, X dollars of coverage. All right. The LLC has become the most popular form of entity generally in, I'm going to say, the last 20 to 30 years. And it's only been around about that long. I think the first state to have an LLC law was Wyoming, and I think it was like 1992, okay? So all of these different things, the corporation, the limited partnership, the limited liability partnership, if you want to, all of those are state dependent, okay? So you have to have a home state for that entity. There's no like federal corporation law or federal partnership law where you can create one that belongs to anywhere in the country, right? If you're setting up a corporation, it's an Iowa corporation, or it's a Delaware corporation, or it's a Wisconsin corporation. And the same thing with LLCs. These didn't have a historical basis, however. These grew out of kind of the practicing law groups and legal scholars who were looking at all the different entities out there, and they were like, all of these have their good points. Wouldn't it be awesome if we could kind of hybridize this, make a form of entity that's good for business people who are just getting started, and make it easy and make it flexible, okay? And so the limited liability company law came out of that. And after that first one was adopted, it was very popular. So all of a sudden, people were spending money to incorporate their businesses in Wyoming, right? Or Montana. I can't remember. One of those two giant states out west. Okay, and so other states got in on it, and they were like, oh, we would love it if people would incorporate here. Okay, so eventually all 50 states got these, and we now have some uniform laws. Iowa goes by the uniform laws. Not every state does, but where there are kind of templates. And you can go look in the Iowa code, and you can see, yeah, this is what an Iowa LLC looks like. Here are the requirements. Here's what you have to do, okay? And the whole idea here is to make something that's easy to set up, easy to use, but still has good liability protection, okay? And you can set up an LLC to look or function like any of the entities we've talked about so far, okay? You can make it look and act like a partnership. You can make it look and act like a big corporation. You can set it up to be taxed like a corporation and then make the S corporation election, whatever you want, okay? It's kind of a blank canvas. It's beautiful. It does have the strong liability protection of a corporation where if you do it right, you can't get through it to the owner's assets. The only downside really is that since this form has only been around for about 30 years, there's not a lot of good case law interpreting these state laws that create those. So you can get in a situation like I had. It was probably 7 or 8 years ago before the change in the law. We had an update on our LLC law. But essentially, I represented some folks who wanted to bring the equivalent of a shareholder derivative lawsuit. You've probably heard of these. This is where a group of investors don't agree with what the company is doing, what the board of directors is doing, and so they bring suit standing in the shoes of the corporation, essentially saying, we own part of this corporation, and we think the corporation ought to be suing you, board of directors, because you're screwing up. Okay. Now, there have been shareholder derivative lawsuits forever. There's hundreds of them on the books, right? You know what they look like. They know how they're going to go. We were dealing with an LLC, and I was talking to the lawyer on the other side who represented the other investors, and I said, hey, I think we're going to bring this derivative suit. And he says, you can't. And I said, what do you mean I can't? Everything's here. Well, there's no such cause of action for an LLC. There's never been one. I said, okay, well, we may have to get this in front of a judge and see how this is going to be interpreted. We ended up settling the case, but it would have been interesting. Now, these model laws get updated and the state laws get updated, and now there's a very clear path for that if you have to do that. But at the time, there's some uncertainty. Okay, so that's one of the kind of the few downsides that I can see. There used to be some kind of wonky tax problems. Most of those have been fixed. So these are usually what people will end up in now when they're starting a company. Nonprofits often are a separate entity as well. Okay? Some are not. So if you've ever lived in a condo, or if you've ever lived in like a rural neighborhood and there's like a condo owners association or a homeowners association, which is just like a group that collects money for snow plowing and maintenance and stuff like that, technically those are nonprofit, unincorporated associations. Okay, that's where you're going to run into those by and large. But like your big nonprofits that are doing like charitable works, religious works, churches, stuff like that, generally they're going to be formed as a nonprofit corporation. And that's a very similar process as forming a for-profit. The form is different and there are some requirements, like if you go out of business, you have to give all of your assets to another nonprofit. You don't distribute them as dividends or things like that. And then if you wish to, you can also apply to be exempt from income tax at the corporate level, and you have to pay a fee to the IRS, and you have to wait for them to go through your application and see if they'll issue that. All right, but that's another kind of entity. And then you might have heard of some of these new entities that are coming out, like B Corps or Benefit Corps, social benefit corporations, L3Cs or limited profit, limited liability companies. Iowa doesn't have any of these yet. We have some laws, I guess, that have been proposed to create these, but these are kind of a further hybrid between like a for-profit and a not-for-profit, where maybe you can make a profit and you would pay some taxes on that, but you could also devote a significant part of your work to a social cause. And that would be a little bit different than the standard for-profit setup. So some of those may be coming out in the next few years. All right, that's a good point to break. Why don't we come back next time and we'll start on franchises.